Hi, today I'm going to discuss a problem that comes up all the time, and that is, why can't I just buy Apple or Microsoft, Amazon or Facebook right now? They are great companies. They keep getting more expensive. If I don't buy now, every day I wait, the price just gets higher and higher. Plus, they are just great companies, so I'm not taking any risk, right? Sound familiar? Well, I'm not here to tell you that I know the perfect answer, but let me provide a big reason why this is not good investing and could leave you with 0% returns over a long period of time. Now, if you are new to my channel, well, welcome. My videos are about investments that anyone in the world can make. Now, I'm trying to help as many people as possible understand what they're actually investing in. See, most people spend more time researching their next computer than they do their next investment. I have built a reasonable sized investment portfolio that I'm going to be aiming to continue to grow at about 20% per year. I base a lot of my knowledge on the great investors. We're talking Peter Lynch, Warren Buffett, Charlie Munger, Mohnish Pabrai, and a handful of others as well. Now, of course, I'm not perfect at this. Not every investment that I make is going to be a home run, but we definitely will find some great investments and we'll push for that 20%. So let me paint you this scenario. Okay, this is you, and you have decided you want to invest your money. You realize that the stock market is a good place to invest and that you want to make a portfolio in companies that have very low risk and you don't have to think too much about. Because you have a busy life and you don't have time to worry about your portfolio, you want it to be safe. After doing a lot of thinking about it and doing your own research, you have decided that Google, Amazon, Apple, Microsoft, and Facebook are the best companies in the world. And if you had just invested in any of these companies 5 years ago, well, you would have done really well. They just keep going up and up and up. So you think you just can't go wrong. Plus, you don't see any possible future where Apple, Google, Facebook, Microsoft, and Amazon are not important companies. See, you use their products and services all the time, and they are a big part of everyone's life that you know. So that's your investment thesis, and it sounds pretty solid to you. So you fund your trading account, and you have a plan of which companies you want to buy, and you go out and buy them all on the first day. You go buy Amazon at $3,200, you buy Apple at $120, you buy Google or Alphabet at $1,750, you buy Facebook at about $300, and Microsoft about $220. These are around about December prices. And you bought at those prices because that was the stock prices on the day, so it won't matter over the long term as prices just keep going up anyway. So you have your portfolio now, and that's it. You can sit back and wait for this to grow, right? Okay, so that is the scenario. The reason it is a very detailed scenario is because this is a true story of a friend of mine who came to me with this exact situation. Now, you might be thinking that there doesn't seem to be anything wrong so far, but let me tell you what is completely wrong with this strategy. Firstly, let me just say that all of these companies are exceptional companies and I would also love to own them all. Seriously, nothing wrong with any of these companies, and I think my friend chose really well. The problem is the price that he paid. Even great companies at poor prices are most likely not going to be a good investment. So I want to remind everyone of what happened to Microsoft 20 years ago. From about 96 to March 2000, Microsoft was the greatest company in the world. They had the world at their feet. Everyone was buying Windows operating systems. Bill Gates was the richest man in the world, and the stock price just kept going higher and higher. The stock price went from $5 to nearly $60 in just 4 years. That is incredible growth in the stock price. Now, during 1998 to 2000, Mohnish Pabrai was talking to people who worked at Microsoft. Some of these people were making big money and had decided to, instead of taking cash, they wanted Microsoft stock instead. Now, to the employees at Microsoft, this seemed like a smart move as the price just kept going up and up. In March 2000, Microsoft had a PE ratio of 65, and Mohnish Pabrai thought these people were taking a big risk. Now, humans forget emotions generally after 17 years. So, most people don't remember what the hype was like, but I can assure you, people were saying things like this. But the stock market is different, the world has changed. Valuation metrics don't apply to tech companies, you can't treat them the same. Does that all sound familiar to you? For those Microsoft employees and all of the other investors out there that were buying in 99 and 2000, well, this is what would have happened to their hard-earned money. So for those people who bought in 1999, they would have thought they were rich watching it go up 50%. Everyone was talking about how investing in Microsoft is smart money and you will get your big returns year after year because that is what has happened. But then for a period of 17 years, these people waited and waited. The stock price moved lower, then just hovered around for 17 years until the price finally returned to its highs of the year 2000 in 2017. That's 17 years of 0% return on investment. Imagine what these people could have done with that money. 17 years to get 0% return is a long time. Now, the story actually isn't over. After 17 or so years of hoping the stock price would turn around, there were a lot of people sick of it. It was a dead stock. It had done nothing for so long. Why they invested in the first place, they couldn't even remember. Most people who had invested had sold their positions and were moving on to something else anyway. In 2016, the PE ratio was now under 15. The company was still a solid company this entire time. They were always making money and always profitable, highly profitable. So the company had finally become undervalued again. And sure enough, the stock price started to move higher and higher again to where we are today with a PE ratio of about 37. So does this look like history repeating itself? Now, I'm not saying that this is 100% going to happen. The PE ratio right now isn't anywhere near those 2000 levels, but it is still higher than it should be. So what is the moral of the story? Well, the moral of the story is that if you don't know how to value the company and you think it is just going to keep going higher and higher, well, you are taking a big risk. And the big risk is that you could make 0% return on your hard-earned money over decades. If you don't know the value of the company, then you also might sell at the completely wrong time like those people did in 2015. So always remember, think about those people who had bought in 99 and sold in 2016 or 2015. These people waited 17 long years and they missed out on everything. They got the company right, but they just paid way too much for it. Look, I can't tell you where the stock price is going in the short term, but I can say that over the long term, undervalued companies will go up and overvalued companies will either stay flat for a long time or maybe even go down. Let me try and explain this with another story. Here is the Dow Jones index. It is pretty much the same as the performance of the benchmark S&P 500. So, there are multiple times in history where investing in the index funds would have led you to long periods of 0% returns. Only if you can hold for 40 years and longer can you get the average 7-8%, because you need those periods of strong growth to catch up for those flat years. It works pretty much the same as what we saw with Microsoft. Sometimes the average PE of the market is above average levels and sometimes it is below average levels. Anytime PE ratios get too high, they tend to move back to the average. When they are too low, they also tend to move back to the average. Look, this isn't rocket science, and we really shouldn't think we know better. So the historical average of the S&P 500 PE ratio is about 20. Right now, it is about 32. Maybe it keeps going higher. I don't know in the short term, but I can be very confident it moves back towards the average in the longer term. So just like the example suggests, if we know roughly what the fair value is of the companies we invest in, we can guess with some confidence what will happen with the stock price in the long term. So how do we calculate this fair value? Well, I have spoken about the PE ratio, but that's not actually a great indicator because it doesn't factor in the growth of the company. I think it's a good measure for the overall Dow Jones and the S&P 500 as a whole, but not for individual companies. But luckily there are a number of ways to do it. And for these companies, Google, Apple, Facebook, Microsoft, and Amazon, I think the best method is a discounted cash flow method. When we invest in a company, do you know what we get in return for the company? Well, the answer is we get a share of the profits. We are the owners after all. Now, the company often keeps our profit to invest back into the business to keep it growing. That's normally a good thing as they can make our profits bigger and bigger in the future. So, to value a company, we need to work out how much money they are making for us and how fast they are growing. So here's an example. Say this year, maybe the company we invest in makes us $1 per share. Then after 2 years, it's $1.10. Then it's $1.21, and it keeps going like this. It's growing at 10% per year. So all up, over those 10 years, we're going to receive $15.93 over that time. Now, the next thing we need to think about is the value of the money in 10 years' time. Would you like to have the $15 today or the $15 in 10 years' time? Well, their answer is you want the $15 today because you can invest that into other things and make even more money. So time actually makes your money less valuable. So we need to factor this in and we discount this $15 back to today's value. And also at the end of 10 years, we can actually sell our shares to someone else. So we also get money for that, and that's called a multiple. Okay, that's all starting to get a little too complicated, so I made it far more simple in my intrinsic value calculator, and we'll use Apple as an example. Now, to get a copy of this exact same calculator, well, it's free and it's in the description if you want. Now, when I say intrinsic value, what I am talking about is based on the growth rate of the company and how much money the company makes. Well, this intrinsic value is the correct share price today. It's not perfect because we have made a lot of assumptions of the growth rates, but it helps us get this ballpark figure. Here are the metrics that I use to find the intrinsic value of Apple. So the growth rates I've just got, I borrowed from analyst opinions from both Yahoo Finance and Zacks websites. So that's what I've just grabbed for those. The discount rate is 8.5 because that's what the S&P 500 would get over the 10-year period. The multiple is 20 because that's the historical average of sort of the tech sector, I guess. The next number is the free cash flow, which I've just pulled from Zacks website as well. And the last number is just the shares outstanding, which I pulled from Yahoo Finance. If you want more of an example of how I pull these numbers, go back and watch my intrinsic value tutorial video where I go through exactly where I pull this information from. Okay, so the intrinsic value that the calculator is suggesting for Apple is about $45, $46. Now that's with no margin of safety. So I think if we wanted to get a good margin of safety, let's say take 33% off that price, well, I think a good buy price would be about $30 a share for Apple. Now these are just my estimations. Please play around with different growth rates. If you think things are going to be better than what I think or worse, well, just change the growth rates in here in the calculator. But just don't forget some margin of safety. See, no one is going to be able to predict the future exactly, so you need some breathing room for your errors. Now, remember how I said that the price moves generally towards its fair value? Well, that is why we need that margin of safety. See, we want to see our investment grow by at least the same as the company, right? Well, if you buy at fair value, that is what you can expect. So, in this example, if you bought Apple at $45, you could expect to see the share price move up at about 12% per annum because that's what the company is growing at. But this isn't perfect. Something might go wrong with the company, or more likely, we are a bit off with our expectations of the future. So, if we have a good margin of safety, then it is far less risky. Now, the current share price as of December is about $120 for Apple, and I think fair value is $45. So, I think it is very overvalued, even for such an impressive company. Okay, so here's the headline of the entire video and what I've been working towards. See, if Apple is growing at an expected 12% per year, then it will take many years for the company's fair value to reach its share price. So, I think there is a good chance that if you were to invest in Apple at the moment at $120, you will get 0% return on your investment for the medium term. It'll take a while for fair value to go from $45 to this $120 price that it is today, because the company is only growing at 12%. Now, I'll say all this and the stock price will just keep moving higher and higher, and that is totally possible. But I hope you know that as the price gets higher and higher, the more riskier it gets as an investment. The further away from fair value the stock price becomes, the longer time frame of poor returns. So here are the current prices and fair prices of the other companies for my friend. So Amazon, in my opinion, is the best deal out of these 5 companies at the moment because it is the only company under intrinsic value. Now, Microsoft and Facebook are not far away either, but don't run out and buy any of these companies. We must have a margin of safety because things do go wrong and these are just estimates. If you respect your money, you'll always buy with a margin of safety, and I think Amazon has a little further to go before it's a safe play. Thanks for staying to the end of the video. Let me know what you think of my explanation. I'm very interested to hear your opinions. Now, if you haven't subscribed to my channel yet, please do so you don't miss out on future videos, and I will see you next time.